Market implosion worse than 2008 Blackstone bank run. In an effort to prevent a bank run that would undoubtedly be devastating, Blackstone, one of the greatest financial institutions in the world, has just prevented its investors from withdrawing money from its flagship real estate fund. Millions of people are asking just how awful things really are behind the scenes after learning that they froze withdrawals. You will not hear about this in the media despite the fact that there are $125 billion at risk and maybe billions more if this problem spreads to other Blackstone-related organizations. Chances are you are unaware of this if you haven't listened to CNBC or Bloomberg. Hello and welcome back to another video on our channel Finance Sense, covering all the latest trends in the financial markets and the economy. Before we begin, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Without further ado, let's head on to the video. Blackstone is a financial institution that invests money on behalf of investors. But it does it on a grand scale for pension funds, established organizations, or the world's super rich. Their wealthiest clients may be anonymous billionaires whose identities and faces we don't even know, but the majority of their clients are regular Americans who just so happen to have a pension plan tied to this huge firm. Blackstone manages just under $1 trillion worth of assets to benefit 31 million pensioners who depend on it for their monthly income. But to be clear, Blackstone is not the same as BlackRock. Although they share a history and have an almost similar name, the two are actually very distinct and rivals to one another. Currently, a real estate investment trust, or REIT, is one of Blackstone's flagship products, and it manages assets worth over $125 billion in the US. Its mission is straightforward: accept investment capital, purchase various properties including single-family homes, apartment buildings, warehouses, and farmland, rent those properties out, and then return the profits to the investors. As one of the largest landowners in the world, it is reasonable to assume that they have fared relatively well in recent years, particularly as rents and property values in the US have risen sharply in the wake of the financial crisis. However, as investor confidence has declined, that has started to shift. Property prices appear to be on the verge of a massive recession as the international economy continues to deteriorate. Why is the start of a bank run manifesting itself in the real estate market of all places? The fund has indeed been performing really well, and it has yet to start to slow down. Over the course of its history, they have given their investors a return of 13.1% on average each year. In the past year alone, they have given their investors a return of 9.3%, which is impressive considering how the stock market has been struggling. The fund is experiencing a liquidity issue as a result of investors withdrawing their money and demanding their money back, prompting them to simply refuse to give people their money back in spite of these very significant accomplishments. However, home and property values are what are known as lagging indicators. Thus, when a cycle of rising property values occurs, it is more common for them to decline after issues start to emerge than before. Because transactions take a long time to complete, property values are slow to respond to changes in the economic and monetary environment. Making a choice to purchase or sell a property can take months or even years, and after that decision is made, the process of locating a buyer or a seller, negotiating the terms of the sale, securing financing, and eventually closing can also take years. This implies that a housing market boom or crash takes years to emerge, but it also suggests that it is pretty simple to anticipate what will happen to the housing market next, which is what these investors are doing. The average rent in the US is currently hovering slightly around $650, down from its peak of over $1,700, and they expect this trend to continue. They're looking at the economy and believe house prices have reached their peak, so they want to sell now. They think that real estate values will eventually decline and don't see any justification for keeping their money in a vehicle that tracks real estate prices. Of course, the fact that debt is becoming more pricey and that the total cost of floating debt for multifamily has increased by up to 8% so far this year, more than double what it was, doesn't help. Blackstone mainly owns multifamily housing and now has a debt of around $50 billion. Then there is the fact that commercial property prices are already declining relative to their rents, with a current cap rate of 5.4% compared to a cap rate of 4.8% at the end of 2021, indicating that commercial property prices have already started to decline. This news is extremely terrible for Blackstone and follows a challenging year for the business as a whole. Blackstone's stock price has dropped by more than 14%, and it has now lost more than 40% of its value in the past year. Clearly, things aren't going well for Blackstone, and the markets are now beginning to reflect this. Recently, they revealed plans to sell MGM Grand Las Vegas and Mandalay Bay Resort casinos for $1.3 billion. Now, some are wondering if that choice was motivated by a pressing financial need that they chose not to disclose at the time. The other main concern here is that investors could be abandoning ship before the iceberg strikes and reality is exposed, since there might be some shady accounting going on behind the scenes that explain Blackstone's enormous successes over the previous year. The fundamental issue is that Blackstone has concluded that their properties have appreciated value faster than other REITs in the marketplace. Now, it's certainly possible that Blackstone is just better at real estate investment, and they were able to choose the properties with the greatest potential for appreciation than their competitors. However, it's also possible that Blackstone's secrecy has just allowed them to exaggerate their stellar performance in an effort to hang on to their existing investors and funding. Financial organizations frequently have fraud exposure when the markets are volatile. Even though Blackstone's stock price has been plummeting and investors have been fleeing, the company appears to be in perfect financial health on the surface. However, during the global financial crisis of 2008, we witnessed companies similar to Blackstone suddenly and unexpectedly collapse. Blackstone by itself won't cause the economy to collapse. But if the economy does collapse, Blackstone may well go down with it. There is also plain truth that property values in the US will drop because they are inextricably linked to debt and, consequently, interest rates. Rising interest rates make it more expensive to possess a property, and the return you may expect from owning it declines along with the property's value. There is no getting around this, and prices have been going up for the whole year of 2022. The Federal Reserve predicts they won't slow down or stop anytime soon. Those who currently own property with variable rate debt will see their payments rise, and some may be forced to sell their properties at a loss in order to meet their financial obligations. Demand will decrease, supply will increase, and anyone with a basic understanding of economics can predict that property prices will decline. Whether Blackstone's influence will endure, this is an entirely different question. But warnings have been sent, red flags have been raised, and things don't seem promising. Hi, thanks for making it to the end of this video. I hope you learned something valuable, and if you enjoyed it, please hit like and subscribe, as it would help us extend our reach to many audiences. Also, make sure to leave your thoughts in the comment section down below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay tuned for the next video.